Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest economic data with regards to global growth and US growth. We'll also have a look at US inflation and a preview of the FOMC meeting this week. We'll do a preview of the Bank of Japan, which is due to meet the week after. And finally, we'll have a look at some very encouraging GDP data coming out of SA. This will be our final Macro Monday for the year. We'll come back on the 12th of January. I just want to say thank you to everybody who's been listening throughout the year and wish everyone a peaceful break over the festive season. We're going to start off with global growth. The latest PMI data suggests that the global economy at this point is still pretty good. The PMI data comes out monthly. Any number above 50 indicates a month-on-month expansion in economic activity. And the global number, 52.7, while it's down from the month before, is still very far north of 50, suggesting that global growth at this point is still pretty good. And if we look at individual countries, looking at the US in particular, US economic activity appears to be pretty good too. We're only going to get the GDP print in a couple of weeks' time, given the delay from the shutdown. But looking at the other high-frequency data, it suggests that the US economy is looking pretty strong at this point, and it's both from a services and manufacturing perspective. So there's little reason for concern about a rapid slowdown in either global growth or US growth at this point. And in addition, the latest PMI data suggests that the US inflation is unlikely to surge. We've been monitoring a series called the ISM Services Prices Paid series. It's a key leading indicator for inflation. Up until the data last week, it suggested that we were likely to see a surge in inflation, and very encouragingly, that series has come down quite materially and now suggests that US inflation is going to stay at around 3% rather than surging to 4% or higher. Sticking with the inflation, core PCE inflation came out on Friday. This is the Fed's preferred measure of inflation. It ticked down slightly from 2.9 to 2.8%. What will be encouraging for the Fed is if you look at inflation based on this measure over the past 3 months, that number is sitting at 2.4%. And if you look over the last 6 months, it's sitting at 2.7%. So it's currently 2.8. Last 6 months is at 2.7. Last 3 months is at 2.4. It's an encouraging development and suggests that inflation, core PCE inflation in the US is likely to drift down. It's still well above the 2% target, but at least at the margin, it looks like it's heading in the right direction. Now, when you tie that in with the fact that the labor data still appears pretty weak, we're only going to get the non-farm payrolls print after the FOMC meets. It'll come out on the 16th of December. So the FOMC is flying blind a bit with regards to the labor data. But if we look at the private sector labor data, it does suggest that we're still in an environment that's pretty weak from a labor perspective. And there is this disconnect that's built in the US. We've got strong GDP growth and a pretty weak labor environment. And I don't think we've fully gotten to the bottom of just what's driving this disconnect at this point. And I don't think the Fed has got to the bottom of it either. But in the interim, the Fed's focus is typically on labor rather than growth, and they would be looking at the latest labor data with some concern. Now, if we tie in the somewhat encouraging inflation data and the concerning labor data, it sets the scene for a cut from the Fed, and the Fed is due to decide on Wednesday. The market is pricing in a 90% chance of a cut, and then in addition to that, 2 more cuts by October. Although they're unlikely to happen straight after the December meeting. The market is pricing in a 50% chance of a cut at pretty much each of the meetings up until October next year. So definitely a softening trend coming from the Fed. That's certainly what's expected from the market. In contrast to the US, the Bank of Japan is set to hike, and their next meeting is on the 19th of December, and that's in response to their persistently high inflation data. If the Bank of Japan does hike, it's going to take interest rates in Japan to the highest level since 1995. Most people in Japan will be quite unaccustomed to interest rates of the sort of scale that we're going to have over the coming year. We hope you're finding this podcast valuable. If you are, please take a moment to rate Investec Focus Radio SA on your podcast platform. And to make sure you don't miss an episode, please remember to follow us. Switching to South Africa, we had a very encouraging GDP print that came out last week. As a starting point, it's worth reflecting on the current forecast for growth for the full year. The current consensus estimate is that the South African economy will grow by 1.2% this year. The SARB is not much different at 1.3%. The medium-term budget policy statement was at 0.2%, and the IMF is at 1.1%. So a pretty narrow range of forecasts, which is what one would expect at the back end of the year. Those forecasts are likely too low. Given the GDP print that came out last week for Q3, we already know that the South African economy would need to contract by 0.3% in Q4 for growth to be 1.2% for the full year. And given that we've seen rate cuts and commodity prices have been very helpful, it seems unlikely that the South African economy would have contracted in Q4. So the net result is that we are likely to see some upgrades, and we've already seen some upgrades to the consensus forecast for growth for this year. Back a couple of months ago, the consensus forecast was that the South African economy would grow by 1%, and over the past 2 months, that number's been upgraded to 1.2%, and we think ultimately it will settle at somewhere around 1.4%. So some further upgrades to come. What's interesting is if you look at South African growth over the last 4 quarters, and specifically if you look at GDP over the last 4 quarters relative to the 4 quarters prior to that, then growth by that measure for the South African economy was 1%. Global growth was a bit higher at 2.2%. So the South African economy is still underperforming relative to the rest of the globe. But what's interesting is that growth in South Africa by that measure accelerated, picked up to 1.2% as we saw global growth decline. It suggests that some of the recovery, some of the uptick that we're seeing in SA growth is due to SA specific considerations. Things like SOEs being less of a binding constraint on growth. And it's somewhat encouraging and hopefully will continue to be the case that SA growth will trend up even if global growth remains stagnant. Each quarter, we measure the performance of the SA economy relative to all other countries that print GDP numbers, and we look at 4-quarter growth for all of those countries. And over the last 5 years, the South African economy has fluctuated between being in the bottom 10% and the bottom 30% of countries. At the moment, it's sitting at the 30% number, which is close to the top end of the range of what we've seen over the past 5 years or so. Should SOEs become less of a constraint on growth going forward and we start to see further SA-specific improvements in growth, we would expect the South African economy to settle at somewhere between the 40th and 50th percentile. So still below average, but much closer to the average than we're seeing at the moment. And that's roughly in line with where the South African economy sat from the late 90s through to about 2012, which we think is more indicative of a normal environment for the SA economy, which suggests further upside ahead should we see evidence of further structural reform in SA. And on that note, we're going to end it this week, and we're going to end it for this year. That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.